Welcome back. Now, this is a continuation of the previous video where we spoke about the fundamental analysis behind how your investments will be managed. If you haven't watched that video yet, please watch it first before you continue with this video, because in this video, we will be exploring the technicalities behind how your investments will be managed from a technical analysis standpoint, and how we combine both the fundamental and technical analysis to help us make sense of what our next steps should be. Right? Once again, here are the standard disclosures. I would not bore you with the details. Moving on. Let's start off by defining what the technical analysis is and what it is trying to achieve. Now, technical analysis is a method of evaluating and identifying a trading opportunity based on the price trends and patterns as seen from the price charts itself. If technical analysis is predominantly used for trading, why should an investor be concerned about it? Or rather, why is technical analysis even relevant to us as long-term investors? As an investor, I'm not trying to use technical analysis as a means to generate short-term profits, but instead, I'm using it to complement and cross-check the findings of my fundamental analysis to determine if the current market behavior is sustainable or not. Okay? You see, technical analysis to me is a means to understand the psychological state of the market participants, whether they are being too greedy or whether they are being too fearful. And from there, you can cross-check their subjective emotions with the objective facts and figures that we have derived from our fundamental analysis to determine if the current market environment poses a threat or presents an opportunity. In the event where the fundamentals of our investments are sound and undervalued, but for some reasons investors are unnecessarily fearful about it, that presents a buying opportunity. Likewise, in the event where our investments are overvalued and the technical analysis is reflecting high levels of greed within market participants, this tells us that the market behavior is unsustainable and perhaps we should manage our risk properly. Now, this is why technical analysis is important and relevant to us as investors. It is to help us make sense of whether the current price action is sustainable and whether or not the current market environment poses a threat or presents an opportunity for us as long-term investors, of which we will then base our decision on to decide what our next move would be, right? Should we increase our investments position and buy more, or should we reduce our risk by selling off some of our investments? With the definitions and relevance out of the way, let's move on to the type of indicators that I'm using to track and monitor our investment portfolio. For our investments, these are the key indicators that I'm using to help us make sense of what is going on with the market participants' psychology at any given point in time. Now, these are the indicators that have worked well for me and is by no means exhaustive. The thing about technical analysis is that there are countless indicators available at our disposal. But it is very important for every investors or traders to eventually realize what works for them the best and you stick to it. Okay? In my case, these are the 4 indicators that I'm always using 100% of the time. Though from time to time, I may also add on a few more indicators to confirm my findings, but I will not be going through these indicators for the purpose of time. Now, firstly, let's talk about the support and resistance line. Now, the support and resistance line acts kind of like a psychological barrier that is formed based on previous price levels. Resistance acts like a ceiling that is formed based on the previous high levels, while support acts like a floor that is formed based on the previous low levels. As you can see from the charts above, the resistance and support line are kind of like barriers that prevents the price from breaking through a certain price level. However, in the event where the prices do break through, it can be often interpreted as a change in the trend towards the direction that the price broke through. If you break through a resistance, you can expect an upward momentum, and if you break through a support, you can expect a downtrend momentum. Secondly, let's talk about the trend channels. Now, the concept of trend channel is similar to the concept of support and resistance lines, except that it takes into account the current trend behavior. There are a total of 3 types of trend channel: ascending, descending, and horizontal, of which from the above pictorial explanation, it should be quite self-explanatory. When it comes to ascending and descending channels, if the prices trade within the channel, as highlighted in yellow, it signifies a continuation of the trend. If it breaks out of the direction of the trend, as highlighted in green, it signifies an increase in the momentum of the current trend. If it breaks out in the opposite direction of the trend, as highlighted in red, it signifies a potential change in the trend itself, right? When it comes to the horizontal channel, if prices break out of the support line, it signifies a potential start of a downtrend. If it breaks out of a resistance line, it signifies a potential start of an uptrend. Now, I understand that there is quite a bit of information here and it can get quite confusing at times. So please pause this slide and replay it as many times as you need to digest the information that was shared. Long story short, the idea is that prices tend to follow the current direction that they are moving. If it goes up, you can assume that it will continue to go up unless prices break out of the channel in an opposite direction of the current trend. Thirdly, let's talk about the Relative Strength Index, aka the RSI. For the RSI, it is basically a momentum indicator which measures the magnitude of the recent price change to evaluate if the current investment that you are tracking is overbought or oversold. Okay, basically, if the reading is around 70, it signifies an overbought market, which can be a catalyst for a price, or rather for a potential price correction, as you can see from the red dotted lines. While reading around 30 signifies an oversold situation, which can be a catalyst for a price rebound, as you can see from the green dotted lines. Apart from the 70 and 30 readings, another thing that you want to take note of is the direction of the RSI readings. If the RSI is moving in the opposite direction of the current trend, it may be an early warning signal that the current momentum of the trend is weakening and may potentially change. This can be seen from the yellow arrows. Lastly, let's talk about the Klinger Oscillator. Similarly to the RSI indicator, the Klinger Oscillator is a momentum indicator that measures the long-term money flow within the investments. There are three ways you can use this indicator. The first is the readings, right? Any reading above 0 signifies an uptrend, while any readings below 0 signifies a downtrend. The second is the direction. Similarly with the RSI, what you're looking out for is consistency between the direction of the trend and the direction of the indicator. If they are moving in the same direction, it means that the current price action is supported by proper momentum. If not, you might want to be a little bit cautious about what's happening. The third is to identify the crossover between the green and blue line, as each crossover signifies a potential change in the short-term money flow, which depending on your time frame, it may or may not be useful at all. At the end of the day, when using technical indicators, what we are looking out for is consistency in the indicators readings. If all the indicators sing the same song and point at the same trend, chances are is that the trend is one that is sustainable and it will continue. If the indicators start to show some readings that are different from one another, you might want to be slightly cautious as to the sustainability of the price action and the current trend itself. Personally, the use of technical analysis is merely a means to complement the fundamental analysis. I do not use technical analysis as a way to identify short-term trading opportunities simply because I view myself as a long-term investor. And I don't want to act on the short-term trading signals because it will affect my decision-making process as a long-term investor. For the purpose of our investments, I will always use the findings of both the fundamental analysis and technical analysis to help us answer the question of whether the current market condition is safe to invest in before we make a decision as to what needs to be done next, right? At the end of the day, be it fundamental or technical analysis, these are merely tools to help us make sense of what's happening in the market. And with all tools, the efficacy of the tool depends on its user, right? A good craftsman never blames his tools. If you're not getting the results that you want, the problem lies with you and the way that you approach investments, and not the very investment instrument itself, nor the efficacy of either the fundamental or technical analysis. So get familiar with each practice and understand what works for you the best. Over time, through reading books as well as trial and error, that is how you hone your skills as an investor. That covers the technical analysis behind how your investments will be managed. Thanks for sticking around the entire presentation. If you haven't subscribed or connect with me on LinkedIn, please do so to stay updated with future content. As what all the other YouTubers are saying, smash the like button and hit the subscribe. Thanks. If you have any other questions with regards to this presentation, you can drop me a comment on the channel or PM me directly via LinkedIn or Telegram. All the links will be in the description below. Stay safe and I hope to hear from you soon.